What if I told you that the biggest financial revolution is happening right now, and most people have no idea? For decades, banks controlled lending. They decided who got loans, who got rejected, and who was left struggling. But today, banks are pulling back, and private credit is taking over. Right now, the biggest investors in the world are pouring billions into this market. Why? Because they see something that the average person doesn't. This is no longer a niche market. This is a trillion-dollar industry exploding overnight. So the real question is this your opportunity to get ahead? Or is private credit a ticking time bomb waiting to explode? Welcome to the Profit Report, your financial headquarters. Let's break down exactly what's happening in private credit and what it means for your financial future. The financial system is shifting in a way we haven't seen in decades. Traditional banks are tightening their lending. Interest rates are the highest they've been in over 20 years. Getting a bank loan is harder than ever. Business owners are desperate for financing. Public markets are volatile and unpredictable. At the same time, investors are struggling to find consistent returns. Stocks are unreliable. The S&P 500 saw a major decline in 2022, and instability continues. Bonds offer low returns, most barely beat inflation. Real estate is cooling off. High interest rates are crushing demand. So where is all the money going? Private credit. Instead of relying on banks, businesses are now borrowing directly from investors. This is why private credit is exploding. But here's the problem. Is this sustainable? The numbers don't lie. M&G just acquired a majority stake in P Capital Partners, a leading European private credit firm. Apollo is building the first private credit marketplace. Ares Management just raised a record-breaking $30 billion fund. Pension funds have increased their private credit investments by 50%. Macquarie is shutting down parts of its U.S. debt business to focus entirely on private credit. These aren't small players. These are multi-billion-dollar firms that dominate the global economy. The biggest investors on the planet are repositioning their portfolios. Why? Because banks are too slow, too restrictive, and too outdated. And if these investors are rushing into private credit, what do they know that you don't? Private credit isn't complicated, but it's powerful. Instead of borrowing from a bank, businesses borrow directly from investors. Instead of earning a low 5% on government bonds, private credit investors make 8, 10, even 20% returns. Instead of dealing with strict bank lending rules, private lenders negotiate flexible deals. Instead of relying on market volatility, private credit provides steady, predictable income. That's why some of the world's largest pension funds are moving billions into private credit. Even retail investors now have access. New platforms are emerging that let individual investors participate in this trillion-dollar shift. This isn't just about making money. This is about where money is moving, and whether you're ahead of the trend or behind it. But private credit isn't risk-free. Private credit is booming. Billion-dollar firms are rushing in, returns are soaring, and the industry is expanding faster than ever. But what happens when too much money floods into a market too quickly? Every financial boom in history has hidden risks, weak spots that most people ignore until it's too late. And right now, private credit has a few serious dangers beneath the surface. With stocks, you can sell instantly. With bonds, there's usually a market to offload them. But private credit? It's different. Once your money is in, it's locked up for years. There's no public exchange where you can just sell your investment overnight. If you suddenly need cash, you have to wait for the loan to mature or find a private buyer, something that's not always easy. This becomes a huge problem in a financial downturn. If too many investors want out at the same time but there are no buyers, liquidity dries up fast. We saw this happen in 2008 with hedge funds holding mortgage-backed securities. On paper, they looked valuable, but when panic hit, no one wanted to buy them. Right now, private credit hasn't hit that crisis point, but if defaults rise and lenders need liquidity, who will step in to buy these loans? At first glance, private credit looks stable, but behind the scenes, businesses are already starting to struggle. Recent data shows that 5% of middle-market borrowers are failing to make payments on time, and that number is increasing. In a high interest rate environment, borrowing costs rise. That means companies that could afford loans 2 years ago are now struggling to keep up. What happens next? Lenders will be forced to restructure loans to avoid total losses. Some borrowers will default, leaving investors with unpaid debts. If a major economic downturn hits, the percentage of defaults could skyrocket. And the biggest problem? Unlike stocks or bonds, where financial data is available in real-time, private credit markets are not as transparent. This means investors might not realize how bad things are until it's too late. Right now, private credit is attracting record levels of investment. Pension funds are increasing their allocations, hedge funds are jumping in. Retail investors are now being given access through new platforms. With so much money chasing deals, lending standards are slipping. The Financial Times warns that many lenders are relaxing their requirements just to keep up with demand. This means riskier borrowers are getting approved. Collateral requirements are being loosened. Lenders are offering longer repayment terms just to make deals happen. In other words, private credit is starting to look like the subprime mortgage crisis before 2008. Back then, lenders were giving out loans to people who couldn't afford them. Are we seeing history repeat itself? Right now, no one knows for sure, but when too much money chases too few quality deals, the system becomes fragile. Is private credit growing too fast for its own good? Some experts are warning that this rapid expansion is unsustainable and could create a major liquidity crisis. Why? Because private credit relies on borrowers continuing to pay their debts. But if the economy slows down, companies with high debt levels won't be able to make their payments. If this happens on a large scale, investors will start pulling their money, but they won't be able to exit fast enough. And when that happens, liquidity vanishes. This is exactly what happened with mortgage-backed securities in 2008. It happened again with leveraged loans in 2020. And now, some believe private credit could be next. So the question isn't just how much money you can make, it's whether you're prepared for the risks ahead. The best investors aren't just chasing the highest returns, they are managing risk. Here's how top investors protect themselves. 1. Invest in deals backed by assets. Look for loans secured by real estate, equipment, or cash flow. 2. Choose experienced lenders. Not all private credit funds are equal. Some have decades of experience, others don't. 3. Diversify across multiple deals. Never put all your money in one place. This is how the pros win. And this is how you can avoid the traps that will hurt inexperienced investors. Right now, private credit is at a tipping point. It's still early, but it's growing fast. More investors are catching on. The best opportunities are disappearing. Will you stay stuck in outdated investments? Or will you position yourself ahead of this financial shift? The investors who understand private credit now will profit the most. They are earning steady high returns. They are not relying on stock market volatility. They are ahead of the curve while others are still catching up. This is why private credit is becoming one of the most powerful investment strategies of the decade. Imagine 5 years from now. Your investments pay you monthly. You are no longer stressed about market crashes. You understand opportunities before everyone else. This is not speculation. This is a strategy that the biggest investors are already using. The financial world is shifting. Banks are losing their grip. Private credit is rising. Those who adapt will thrive. Those who ignore it will be left behind. If you understand this now, you can make smarter financial moves before the rest of the market catches on. Private credit is no longer a secret. The biggest financial institutions are already shifting billions into this market, positioning themselves ahead of the curve. The question is, will you take action now, or will you watch from the sidelines as the best opportunities disappear? If you want to invest in private credit the right way, you need to understand where the real opportunities are, and how to avoid the biggest risks. Our next video breaks it all down for you. How to get started, where to find the best deals, and the mistakes that could cost you everything. Don't wait until it's too late. Watch the video above and take control of your financial future.